Well, thank you, Larry. Welcome everybody to this presentation, and I know you're going to learn some very useful information about some cycles that are coming up and some top tips. But before we get going, first of all, we have to start with the traditional disclaimer, and that basically says if you're over in Europe and Britain here, then this is educational material. Don't trade from it. It's not trading information. And perhaps a better disclaimer from the American authorities, there's trading stocks and all other financial instruments involves risk. Past performance is no guarantee of future results, and we make no representation that anyone will or is likely to achieve similar results. So now we've got that out of the way, let's go on with some educational stuff, and I know you're going to enjoy it. So, do you think markets are random? Well, basically, what would happen if you knew that the S&P is about to change trend? If you knew when that was going to occur, how would that help your trading? I mean, we're talking about gold, crude oil here, the euro, S&P 500 already mentioned, dollar index. And how would timing help your trading and investing? Would it turn potential losses into profit? Would it give you the edge? I can tell you it probably would. And if that was the case, how would this change your financial destiny and freedom? These are questions you want to ask yourself. Now, what I want you to do is get a pen and paper to make some notes. There's some important dates coming up, plus some a very special multi-million-dollar tip. And I really want you to make a note of these timings because they will definitely be very useful for you. So just go and get a pen and paper. And right, so most of the world feels that markets are completely random, that there's no order in them, they're driven by fundamental news, and therefore they can't be timed or they can't be predicted, nothing can be done. And I used to feel exactly the same way. And I used to trade. I had trades that were very profitable, but I often stayed in too long, and the profits turned to losses because the trends had changed. You know, that was it. Has this ever happened to you? Well, I'm sure it has. And basically, this set me off on a journey, a massive journey. And you know, some of you may have seen our website. You know, there's a little bit more detail on there. But I studied a whole bunch of people in the systems and ideas, a lot of GAN stuff. I was Peter Pick from GAN Trader, and all sorts of other cycles. I spoke to historians. They didn't even realize that there were cycles repeating mathematically. But I put all this together and found that cycles categorically repeat in life, in history, as I've just mentioned, and of course in all financial markets. So put this information in and then projected it forward, and basically managed to predict the stock market run in the late 1990s. Yes, I'm a little bit older than I sound. The 2008 crash, the 2010 commodity run. I'm going to tell you how these were done, and the low to the day after the 9/11 collapse. And we literally had thousands of accurate forecasts. Even the January 2016 sell-off. There's some important stuff coming up. I'm going to share that with you as well. And that is really big stuff coming up over the next few years. So, you know, it's only a few minutes this webinar, and if you get a couple of things that give you some great opportunities, that would be absolutely fantastic. So, as I say, we're going to look at some of these techniques, and the value is really in synthesizing a lot of these techniques. The MTR is a market timing report. I'll tell you about that a little bit later. But first of all, I'm going to talk to you about the decennial cycle, the super macro cycles, and I want you to beware there is danger ahead. And we'll talk about that in a little bit more detail. I'm going to talk to you about non-linear proportion. Sounds weird? No, do not worry. We'll explain it exactly. And I'm also going to show you how my readers of the Market Timing Report were given the exact high price of the NASDAQ 100 9 months in advance. I'm going to show you that technique. It's a multi-million, multi-billion-dollar system, and that we'll cover as well. So let's start off with the decennial pattern. Many of you have heard of, or I'm sure most of you know about it, and it all stems from a book that came out in 1939 by Edgar Lawrence Smith called The Tides and Affairs of Men. And basically what he said there was years ending in 3, 7, and 10. So we're talking about like 2003, 2007, 2010, 2020, 1987, etc. And sometimes years ending in 6, that's a warning, we're in a year ending in 6, 2016, are often down years. Years ending in 5, 8, and 9 are generally advancing years. And he looked behind all this, and he's found that weather systems replicated in a similar way in sunspots and radiation. And basically, he thought these things had an effect on the optimism and pessimism levels on human beings, and this in turn reflected on the market. So there's certainly some truth in that. Now, let's talk about some super macro cycles, and I'm just going to show you one of the key cycles of the stock market. And let's start off in 1929, because I'm absolutely sure you are all aware that there was a massive crash, the Wall Street crash in 1927, reverberated across the world, a huge event. But what you might not be so aware of is 72 years earlier, in 1857, there was the global financial collapse. It started in America, in Cincinnati. The Ohio Life Trust collapsed, and it sent a cascade of other things. And not only that, simultaneously in Britain, in Europe, there were problems, and they just happened to tie in at the same time. You'd say it's coincidence, but except we know the cycles, and no, it's there's nothing. What's a word I'm looking for? They are set in cycles. There's nothing. There's no chance about it. So 1857 to 1929, 72 years. If we take 1929 and project forward 72 years, we get 2001. That gave us. The major high was actually 2000, but it was close enough. We stayed sideways there, then we started to collapse in 2001 that accelerated with 9/11. So when's the next one? Simple. Let's just add 72 years and we get 2073. Tell your grandchildren. But don't worry, you don't have to wait till 2073 for the next big collapse. So those are some really simple stock market cycles. We'll talk a little bit more in a minute. But let's have a look now at some commodity cycles. In 1720, we had the South Sea bubble, where there was massive inflationary pressure. Commodities went racing up. And then 1864, we had the Civil War commodity boom. So prices like, for example, the price of cotton went from 3 cents a pound up to a high of $1.89 on the 23rd of August, 1864. Gann documents that if you're fans of Gann's work. And basically, it was this massive event because, America was in the middle of war. There was nobody out to look after the crops and everybody was out fighting. The demand for cotton was through the roof because they needed it for uniforms. So if we take the same distance between 1720 to 1864 and project that forward, that gave us 2008. And again, there was a massive commodity boom in 2008. Now, if you look, that's 144 years apart, each of those cycles. So we knew that was coming in. It's as simple as that. And remember, on the previous slide there, these cycles were 72 years apart. These cycles are 2 times 72, i.e. 144 years apart. So there's very clear order going in these markets. So the next cycle is going to be in 2052. Who knows? Who cares? It's a long way away. I know we'll all be gone by then. But don't worry, there are plenty others coming up before then. I'm going to share some more of them with you. Now, we're talking about super macro cycles. Let's talk about the 100-year cycle. They replicate in wars and markets. So, let's just go back 100 years. And let's think about the First World War, 1914 to 1918. Go back 100 years before that, and you'll find that Europe and other parts of the world were in the midst of the Napoleonic Wars. And in fact, 1814 1812 to 1814. So 1814 was the end of the 1812 war, where Britain and America were at war. So you can see there's a lot of conflict going on. So the question is, are we at war now? Well, I'll leave you to make that judgment. I know there's a lot of terrorism going on. It's a different kind of war. It's going to escalate, and that's the cycle we're in. It's a more subtle thing. Also, half a cycle is always important. So let's look at 1857 and the 100-year cycle. Half of that is 50 years. And if we add that, by the way, let's go 1857 plus 100 years, 1957. Those are very, very big stock market sell-off in 1957. Now, take half that cycle as a saying, 50 years. 1857 plus 50 years is 1907, the rich man's panic caused by the sudden drying up of credit in 1907. Add 100 years to that, 2007. What caused the global financial collapse? Well, the top was in 2007. Credit suddenly dried up, and that was it. We were away. So that cycle works like clockwork. Now let's come into a shorter cycle, and let's look at that one. The 7-year cycle is a very a good one to look at. And let's start in 2001, because again, we all know 9/11 happened. Add 7 years to that, we get 2008, and as I've just told you, that's when the collapse. 15th of September 2008, Lehman Brothers, the crisis happened there, and that's exactly 7 years on from that. Add 7 years to that, we get 2015. That's been the high on the stock market. It's still been holding, and we can't deny that's not a major high. And that's an important one. But go back to 2001 and go back 7 years from then, and we get 1994. 1994 is a major low before the massive bull run at the end of the century. And by the way, the bull run 1995 to 2000, 2001, go back 100 years, you'll see that happen at the end of the 19th century, and you'll see it happen 100 years before that as well. Like clockwork, 5-year cycle. 5 years of going back 100 years. So 1795 to 1800, 1895 to 1900, 1995 to 2000, massive bull markets. So that's kind of that one. Going back to the 7-year cycle, that was 94. Go back 7 years before that, we get the 1987 crash. Go back another 7 years, go to 1980, the Homeland Crisis. Go back another 7 years, we'll get to 1973, and that was the global crisis created by the Arab nations hiking up the price of oil and putting most of Europe, most of the world into recession. Now, we talk about a 90-year cycle. Let's pay attention to this one. If we go back to 1929 and add 90 years, we're going to get 2019. That's not so far away. Just bear that in mind and write that down on your piece of paper, because that's information that's going to be useful to you. Then we have a 45-year cycle, which is half of a 90-year cycle. Now, two things here. Going back to the previous example, if we take 1929 and add 45 years, we get a major low in 1974 in the stock market. And then it goes without saying, add 45 years to that, we get 2019 again. So you can see how this cycle's coming in. But most importantly, right now, this I'm actually recording this in the first week of May, 2016. There is a 45-year cycle that affects currencies. So back in 1971, in May 1971, several nations depegged themselves. There was known as the breakdown of the Bretton Woods Agreement. Now, the Bretton Woods Agreement was all about every nation should peg its currency to the US dollar. And each nation then had to buy and sell reserves, including gold, to maintain certain parameters in their exchange rates with the US dollar. However, President Nixon decided that his regime was going to print dollars. So, familiar story these days. The thing is, the German nation were the first to get very upset because America could literally just print money and everybody else had to effectively pay for it. So they decided in May 1971 they were going to depeg. They did their own thing, and that sent exchange rates all over the place. The dollar actually started falling apart. Immediately, Austria and the Netherlands and several other European nations did the same. Now go back another 45 years and you'll find that the French franc was depegged from gold, so 90 years ago this month. That's really interesting because, it's the same sort of idea. Now, so bear that in mind. Now, twice the 90-year cycle, or 4 times a 45-year cycle is the 180-year cycle. If we go back 180 years, well, actually 179 years, we'll go to 1837, when America went through the land panic. It was all about over-speculation and construction of canals, especially around the Chicago area. And that created a big crash and a depression that lasted several years. So can you see now that possibly next year, not possibly, but probably next year, there is going to be a very big downturn coming in. And it could all be to do with whoever runs the economic policies next year. I'm not going to say anything about that. And then, a couple of years later, we're going to be hit with this big cycle in 2019. Big set of cycles are all coming together. Not only that, as we come into next year, we're going to see some different types of cycles. And there's a cycle that ties up the Civil War period of 1864 with next year. And that, obviously, the 1864 cycle is very divisive for the American nation. leading in war, and we're going to see some divisiveness coming in. So we're on danger alert, because whatever, like they say, when America sneezes, the rest of the world catches. Sorry, America sneezes, the rest of the world catches a cold. So there's some cycles, and I'd like to think about those. I hope you made some notes on those, because that can really help you out there. Now, let's move closer into home, because ultimately, if we invest and trade, we really need to know the shorter cycles as well. And so let's look at some non-linear cycles, as I call them. And these come from our cycles analysis programming suite that we've worked on for over 20 years now. And we provide this information in the market timing report. So here's the S&P 500. And what I'd like you to look at here is that as we go under this, we put a series of histograms. And these histograms peak. Where they peak, there's a high here, there's a high here which goes up there, there's a high there, and there's a high in the histogram, there's a market high, there's a low that actually came down to there. You can't see it's covered by the red line on this peak here. Histogram peak here, that's the high, major low there, and so on. So what we can see is that as we go into the future, we can see where potential market changes are likely to come in, and it's based on some of the techniques I've just shown you. And we're able to look at future turning points and identify them well in advance. And here, this chart here is projecting all the way to 2022, and I guarantee you that these points that are highlighted here, and I'm going to tell you about some in a minute, are going to be major turning points. So please make a note of those. Just going into a little bit more information on this, though, what we do is we compare several sets of cycles. So a macro cycle, an intermediate cycle, and a short-term cycle. And this one here is on the euro against the US dollar. But you can see here there is a very big cycle, intermediate cycle, and a daily cycle. And when you get all these coming together, we get the end of major moves like you've seen over here. And I mean, that's really useful. So it really helps us show not only when a big move's ending, and also, I mean, here we started just there. You see, interesting enough, not there, but there is actually the true cycle low, because we've got these coming together. And so this helps us identify in advance. And how do you use this information? Well, if you were long this market and we told you there was a big turning point coming up, you'd either want to be looking at cashing in your profits, or certainly hedging your positions. And once you've got through this cycle point, it also suggests a time when you could, subject to your own trading systems indicators giving you confirmation, possibly start a campaign. So moving on, coming back to the S&P 500, make a note of these dates. These are two very, very important cycles, July 2016 and October 2017. Mark them down and look at this. Look at the size of this spike. I mean, look, here's the 87 crash stuff going on here. It wasn't that big a spike. You can see here that these things here highlighted this area here and so on. As I say, this is just one cycle set. This is a major cycle set. These brought in that spike, the low we had, and our readers knew the low was in, whilst the rest of the world was thinking that this market was going to crash forever, and that's just only since January, February. So make a note of these, July 2016, October 2017, there's going to be significant turns then. So basically trends are going to change. Do we know if it's going to be up or down? Well, we'll know, because we'll know which way the market's going into those time points. So I promised to share a multi-million-dollar secret with you, and you can use this right now. You don't need any software. You don't even need a calculator. It's really quite easy, and it's something that I know a lot of very big players use, and billionaires. In fact, there's a very famous billionaire that I consult to. I can't tell you his name, but he uses this, and he makes an awful lot of money just from this alone. So, in the January 2015 edition of the Market Timing Report, I told my readers that the NASDAQ 100 will make a tie at a price of 4737. I was absolutely precise with that price, and this is what was the market was looking at there. This is what I printed in January 2015. There was still a way to go, and I knew it was going to get up there. And I'm going to show you exactly how we do this. And take a look at the next chart. It's as simple as this. If we take this low here and this high, so and then we project this difference up, so add this amount of price to this, that gives you that projection there. Why these two? Well, basically, once we got up here, we pulled back, and then when the market went through here, it pretty much went straight up. You see, it wasn't pulling back like this, so you can see the structure of the market had changed once it got through here. So it's pretty obvious that this was a major turning point, and then it was going to head up there. Not only that, that price there pretty much coincided with a double top. So, in traditional charting, that's always going to have some impact. So it's as simple as that. Now, you can do this. You take the first big impulse move and then just double it. And even if a market's coming down, you take that and double it, and you'll get a major support resistance area. That's the way it works. So I hope you find that useful, and make a note of that one. So using this information, this is exactly what happened, and that came in off the top of my head. I know there was a high in December, and it was November and there we go. November and December were the exact highs. So that information was given, 11 months in advance. And there it was. It actually traded within 2 ticks. It actually went through that by 2 ticks. 4737 was the number. I think we traded 4739, and then it came off like that. Now, if you knew, and we gave timing on these cycles as well, so if you knew when that was going to happen, and you caught most of that move, or even a part of that, you would have been very, very happy with that. So that's that, and that's where we're at. So that's one of the benefits of the market timing report. And what the market timing report does, it provides you with timing windows, and we fine-tune them down to the day for each month for 5 markets: the S&P 500, gold, crude oil, the euro, and the dollar index. We use seasonal probability as well, so that helps. And just to let you know, I was privileged enough to be invited with around about 40-50 other people in a room for a very special secret meeting, and it was hosted by Tony Robbins, who is interested in this work and the system we use, and Jim Rogers, the multi-billionaire commodity trader, was there. Harry Dent, the demographics expert, was. His stuff's great. He predicts a lot of good stuff with his stuff, but he's not able to get it into a very small time window, which is what we're able to do this. Bob Proctor from Elliott Wave was there as well. Some very, very big names use his stuff. So you need to use it with your own trading system. Unless you have your own system, you'll never be successful, and it really can help you out if you fine-tune that. So the other thing I want to show you is that every month we put key dates on the front, as well as the actual dates there, and this is the latest issue. And this is the history, the track record. It's only been published, this letter, for 2 years. Now, historically, we didn't used to publish a letter because we only sold this information to a few funds and some very high net worth traders. And people kept saying, you're very accurate. Please do something that we can all access and that's affordable to all of us. So we created the market timing report, and this is it. So if you remember, we put key cover dates. Now, the key cover dates are the arrows. And the other green boxes are the dates that we give you in the report. We'll give you a few additional dates. So if you look, we've caught pretty much every major move since then. We haven't got them all. We missed that one. I think there's a couple here we missed. But for the most part, we've got them. And, it's very useful information if you know when it's going to turn. So how do you use this information? Well, you might have a fundamental view that something's about to happen, but you're not sure when. This is pretty useful. I already talked to you about protecting trending positions. So, if you, and this is really where I started, I would stay in positions too long and watch big profits turn at times even into losses because I stayed in too long, expecting it to turn back up. So with this information where you think, okay, well, we know the trend is about to end or there's a potential time window, then if you're in the position, you want to raise your stop losses or hedge or just get out. And if you're looking to enter a position, you wait for the reversal to take place off these cycles and then just find a safe risk-reward setup and go in with there. So it's very useful with Fibonacci levels. Where this is beneficial is you never know if a market's going to retrace to the 0.382, the 50%, or the 0.618. So if there's a time cycle that we say is a major cycle, and the market's approaching the 0.382, then it's probably going to turn at the 382. But if it gets to the 382 and there is no cycle, it's probably going to go through to the next level, either the 0.5 or the 0.618. Very useful for, again, similar sort of work with Andrew's pitchforks. I'll show you an example on that in a minute. Commitment of traders reports are really good, but they're never able to tell you exactly when things are going to turn. You can see when a directional change is starting to materialize between the various different investors, traders, hedgers, etc. And we've got examples of this work on our website. So here's one of the things we put in our pilot report, and this was actually created for Harry Dent, had asked us to do this. And what we did here was very simple stuff. First of all, was look at this high here and this low here. So this is the red lines, and the 50% line was right there. Then we took the last major swing, the green line there, and the 0.618 level was there. But we had this major peak coming in, okay, big peak. And you can see this peak here brought in that one, and this peak brought in that high. So we've got a peak coming in here. And so we knew it was going to turn. But you see, this is a monthly chart, and we could see the euro went sideways for several months. So if you were trying to short off there and not getting much traction, to keep taking that on a spot or a futures position is really going to drain your account if you're trying to take that trade for several months. But our cycles were very precise. Not only do we have a super macro cycle, we had a daily date, and Harry and the few people that got this report, I think there's probably a couple hundred people that got this report well in advance, and they were given this date, and that's exactly when the market went, and that was a $36,000 per contract move down. So this is the sort of information that we can provide and how to use it. I also talked to you about pitchforks, and actually this is the very best example ever. So I'm not saying it's going to be as good and easy as this every time. This goes back to December year before last. These are dates we published in our report: 5th of December, 17th, 18th December, and the 26th. So this is what happened. We were long up in here. Now, the interesting thing is that once you hit the pitchfork, it could keep going up, and it's unlikely to go through. But we knew this true cycle was going to be here on the 5th. So as we had no cycles, so we knew the trend was probably not going to finish there. We actually went short off that cycle, and we were actually long into it, and then took profits, came out of here, went short, and it came down straight into our next date. Now, see the Fibonacci levels. Had this gone, had there not been a date, this could have gone through to the next level, but here we knew the 0.382 was more than likely going to work because the 17th, 18th December was one of our market timing report dates. Not only that, we're on the median line. So this was a perfect opportunity, and we did a stop and reverse here and went up all the way up to here to our next date, and that should be the 26th of December 2014. But on that date, we hadn't quite reached that level, so we got out there because we knew the market was probably going to sell off, which it did. Now, most pitchfork traders would have probably waited to get out here and put their orders up here. So that's another way of using it. So you do have to use this information with your own systems, but it is very, very valuable. So what I'd like to do is give you a special opportunity to working here with Larry Jacobs and Traders World to try out this report. Now, we're going to take all the risk. All the risk is on us. We put in some tutorial content most months, and you've got to remember, historically, this information we only provided for a lot of money to only a very small handful of funds. There's no quick fix in trading. We can't bring the cycles forward, but we can tell you where they are. And this can just absolutely save your life or give you some great opportunities. And we've already talked about the 2017 cycle. This report will be honing in on those dates, and we anticipate getting very close into the exact dates of these moves. We've got cycles coming in July. We already have a pretty good idea they're going to be during the first week, and we'll pretty soon we'll know which date within that first week, etc. So we've got a lot of cycles. So what I'd like you to do is go ahead, try this out. If you don't like it, we're going to give you a 28-day money-back guarantee. And let's say, and what are we doing here? Well, we've been running a 57% discount right now, but for this link and only for a very short time, in fact, only for 24 hours after this goes out, we're going to take it all the way down and give you a 66% discount. So you're getting this for only 1/3 of the normal price. And, that's a $495 special. And, please go ahead and try it. And I'm sure you'll find it very valuable, especially when you combine it with your own system. In the scheme of things, $495 is a very small amount. It's less than 10 points on the E-mini S&Ps. And I know it'll be very valuable to you. So thank you for listening, and I hope you found the session very useful.